Hello everybody and welcome to this, the first of what we hope will be many monthly financial planning updates. My intention is just to do a brief 5 to 10 minute video at the end of each month, just to give you an update on how things are going in the markets, report on any tax changes, any other sort of financial planning strategies that we're working on with clients, and also highlight a couple of interesting cases that are in the media or in the news perhaps. So without further ado, let's have a quick look at the markets 2021 year to date. Now, we've seen a real reversal in fortunes in 2021 in that the UK market is actually one of the best performing, if not the best performing, major international stock market. And this marks a really significant change, I suppose, ever since 2016, really, ever since the Brexit vote and the resulting trade wars and issues over trade agreements, currency devaluation, etc. The UK market, the FTSE 100, has really lagged behind most of its international counterparts. And I think since the finalisation of the Brexit trade deal, of course, we've also got very positive progress on the vaccine in the UK around COVID-19. We're much, much further ahead than the vast majority of other Western nations. And that's now being reflected in stock market performance. So the UK market has actually had a very strong start to 2021. We're up roughly 3.5% versus a slight fall on both the global market and also in the US as well. So this is quite a refreshing change and actually plays quite nicely into the Buckingham Gate portfolios, which tend to have a slightly larger weighting to UK assets because, of course, that's our home market. Now, most people would have also seen stories over the last few months about the Robinhood trading activity to do with GameStop and a few other major companies. I think, to be honest, that's a bit of a sideline, really, and you might have noticed that the GameStop share price has now decreased back to its pre-Robinhood level. So it was a blip, if you like, in the market, maybe for 2 or 3 weeks. I don't really think that has any major implications for long-term investors. It was a bit of a storm in a teacup, really. And of course, it had an impact on some of the major hedge funds, but that shouldn't really affect most average retail investors. The final thing to talk about is Bitcoin as well. That's been in the media a lot recently, especially since Elon Musk and Tesla have taken quite a significant stake in Bitcoin. We remain of the view that it is a completely unregulated and almost unidentifiable asset class, really. People call it a currency, but in order to define something as a currency, it has to be a widely accepted medium of exchange. And I'm not sure that Bitcoin necessarily meets that definition at the moment, both because of its lack of acceptance in all sorts of different scenarios, but also because of the limitations of the system. The way Bitcoin is designed limits the number of transactions that can be posted within the Bitcoin system. So any suggestion that Bitcoin is going to take over from all of the major currencies, I think, is relatively flawed. That's not to say we may not use some form of cryptocurrency in the future, but I'm not convinced that it's going to be Bitcoin given all of its inbuilt limitations. So I certainly don't consider Bitcoin an asset class or an investable asset class at the moment. I see it really as a form of speculation. There's nothing to prevent people speculating if they wish to, and sometimes people will make quite a lot of money speculating. But the FCA has been very clear here. There's absolutely no protection, there's no regulation, there's no fraud prevention when it comes to Bitcoin. And so you should be prepared to lose absolutely everything if you're looking at exploring that kind of asset class. We certainly won't be including it in client portfolios anytime soon, let's put it that way. So I'm going to look ahead to the budget now. Of course, the budget is next week on Wednesday, and there's a few themes now starting to emerge. I'm always very, very clear with people that we shouldn't take action based on rumour or speculation, nor should we not take action based on rumour and speculation. Financial Planning 101 says that you plan based on the current known tax situation, and then you adjust the plan accordingly if things change in the future. And it's important to note that there'll always be a reason not to do something. After this budget, I'm pretty confident they're going to announce another one in the autumn. After that one, we'll have one in the spring again. So these financial events come around roughly once every 6 months. So there's always something on the horizon that might change the financial planning landscape. But what we can say, and of course this is just based on our contacts in the financial planning technical arena, based on media reports and articles, there are a few things that are now starting to emerge consistently that are looking, I would say, fairly likely to be included in the budget. The first of those is the freezing of the £50,000 basic rate tax band, so that this is the threshold when you cross over into the 40% tax band. I think it's looking fairly likely that that will be frozen at £50,000. Considering that it's been increased quite aggressively over the last 3 or 4 years, I don't see that as being a ginormous surprise, really. And I think it's relatively reasonable in the context of the country's financial situation at the moment. Now, of course, you could argue this is a bit of a stealth tax. It will kind of erode the real value of the basic rate band over time. What remains to be seen is how long they freeze it for, whether they freeze it just for this year or whether they announce a longer term freezing. What's also now widely rumoured, this has been in the press just today, in fact, is a freezing of the lifetime allowance. This is around pensions. So the lifetime allowance is now just over £1,073,000. It's been widely reported that they're going to stop index linking the lifetime allowance. Now, it's funny this should come up today because I was having a conversation with a client just earlier this week suggesting that exactly this thing might happen. Although I don't think it's very likely that they're going to cut the current lifetime allowance, a government favourite method of stealth taxation is to stop index linking existing allowances, and that's exactly what's being proposed here around the lifetime allowance. To be fair, inflation last year was incredibly low, so the planned increase to the lifetime allowance was only around £5,000 this year. But it is being reported that they might freeze the allowance until the end of the current parliament, which could of course have a larger impact. It's widely, again, rumoured that we will see increases to corporation tax. There's a little bit of debate over how much corporation tax might increase, but I think it's reasonable to assume that we might start to see some kind of corporation tax increase as we go into the budget. And I think what we'll also see is a whole raft of additional or extended support measures for the economy, for businesses, for jobs, but probably for a relatively limited time. I think what the message will be in this budget is that we will continue to support people during the height of the pandemic, but of course, given that the plan now is to open things and effectively remove restrictions by June, I suspect that's probably where we'll see the cut-off line drawn around all of these different support measures. And beyond that, of course, the message will be that we need to start repaying the debt. We can't continue to borrow at this type of level. So I think we'll see lots more support, but I think all of it's going to be time limited, probably till that sort of June window when restrictions start to ease. So what's not looking likely at the moment, and of course this is all just based on media reports and our contacts in the financial planning world, I don't think we're going to see increases or changes to either capital gains or inheritance tax for the time being. Now I'll come on to consultations in just a moment. I've commented before that both of these taxes, if they were going to make some of the changes that have been proposed, it would effectively require a complete rewrite of quite a significant part of the overall tax legislation. So although I'm not saying these things won't happen at some point in the future, I think for the moment, the infrastructure and the level of change that would be required in the tax system means that we're unlikely to see them right now. It's been reported that they were also going to freeze the personal allowance at £12,500. However, that now appears to have been ruled out based on media reporting. So it would seem that the personal allowance will increase in line with inflation, albeit that increase is going to be very modest this year. But the basic rate band that we spoke about before, £50,000, that will remain roughly where it is today. And the other thing I don't think we're likely to see for the time being is major changes to income tax, national insurance or VAT. Of course, the Conservatives have a manifesto pledge not to change the headline rates of tax in those areas. So I suspect they will continue to maintain the status quo for the time being. Now, what is very telling is the government has announced that on the 23rd of March, they're planning to launch a range of consultations and other exploratory papers. Now, I think it's very interesting that they've separated that from the budget, because normally what you find is that the budget would contain these kinds of announcements, but this year they've separated it. Now, my suggestion is that they're trying to divert media attention away from the consultations. My own view is that the budget is going to be fairly benign from a tax and personal financial planning perspective. I don't think we're going to see too many major changes. And therefore, it's actually going to be quite a quiet budget from a kind of reporting point of view. I'm pretty confident the government wants the message to be focused on the COVID support and the recovery of the economy in the coming years. And therefore, the consultations they've deferred to a few weeks later, because I suspect there might be some more juicy headlines contained within the consultations. Now, what they're going to consult on, I don't know. I wonder if it might be something around inheritance or capital gains tax potentially. And I think there's probably going to be quite a lot of potential changes that they're consulting on. Now, I always stress that consultations don't really mean anything, although the government might consult on things, and of course they consult on things all of the time. The government often ignores its own consultations. Sometimes they roll on for years and years and years, and very often they don't lead to any change whatsoever. So although it can give us some insight into the government's potential thinking, it doesn't necessarily mean that we will actually see changes implemented in the future. So those are my views and predictions. Of course, I don't have any direct inside information from government, and of course we'll be keeping a very, very close eye on the Chancellor's speech on Wednesday next week, and we'll have bulletins and other content going out to clients to report on any relevant changes. So finally, just a couple of items that are sort of in the news, if you like. The first of which is around a probate case, and this is actually an interesting story from one of our colleagues in the financial planning world. A very frustrating case where the financial planner involved had recommended that the client rewrite their will and implement a trust framework, as we would do with the vast majority of our clients. Now, this was a married couple, Mr. and Mrs. Jones, and one of them passed away, leaving all of the money to the surviving spouse within a life interest trust that had been included within the will. Now, unfortunately, the surviving party toddled off to the local high street solicitor, and the solicitor recommended that everything was unwound effectively. They said, well, you don't need the trust because you can inherit the nil rate band of your spouse, which is true. And therefore, why bother with the trust? Let's just give you all of the money and then it keeps life simple. Now, unfortunately, the surviving party then went into care shortly afterwards. They lost mental capacity and went into care. And the care fees eroded the vast majority of the estate, depriving the children of almost all of their inheritance. Now, had the probate solicitor actually followed through with the planning as it was intended, if they put the money into the life interest trust, there's a very good chance the fund would have been protected against that care fees assessment and the children would have then received their inheritance. So I think this story does really highlight the importance of taking good advice at the probate stage, as well as in the initial phases when you're drafting wills and trusts and things like that. Now, another case which has received a little bit of media attention is the Rochford versus Rochford case, which has just finished going through the courts. And this is a situation where an adult daughter has made what's called a Family Act or a 1975 Act claim against her father's estate. Now, that the Family Act is designed to cater for dependent beneficiaries that are reliant on somebody where they've been left out of a will. So, for example, if you have a young child with a disability of some description and they're financially reliant on you and you don't include them in the will, they can make what's known as a Family Act claim on the basis that they were financially dependent on that person and they need some kind of financial support. So in this particular case, in the case of Kenneth Rochford, his daughter had a £25,000 legacy in the will, and the estate was worth just about 200,000. Now, a couple of years earlier, they'd had a dispute which caused Kenneth to rewrite the will, reducing the legacy down to 25,000. However, in the 2 years that followed, they'd reconciled, but the will was never updated. So at the point of Kenneth's death, his daughter was only entitled to 25,000, and she made a Family Act claim, given that she had a disability and she was dependent, and made a claim for further support. Now, the rest of the estate had been left to one of Mr. Rochford's siblings, his sister, in fact. And this case went all the way to the courts, and the courts have actually awarded his daughter an additional £85,000 on top of the 25,000 that was originally left. But also, he awarded roughly £60,000 in penalties and costs because the sister refused to go to mediation. She took it straight to court. So in addition to finding in the daughter's favour, the courts have also penalised her for not being more cooperative in the early phases of the dispute process. Now, I think this highlights a couple of things. The first of which, of course, is to make sure that your will is updated to reflect changing circumstances. Of course, if Kenneth had updated his will when he reconciled things with his daughter, none of this would have happened. But it also shows the impact that costs and legal fees can have on the overall estate. So it is important to make sure that things are professionally drafted and that wishes are very clear to prevent these kind of disputes happening in the future. So that's everything for today. I hope you've enjoyed this video update. Please do give us some comments and feedback and any messages of items that you'd like us to include in future updates. As I've mentioned, we're planning on doing this kind of update at the end of each month. And so hopefully you find them useful. Thanks very much, and we'll speak to you soon.